On September 14, 2008, Wall Street woke up to a shocking headline. Lehman Brothers had filed for bankruptcy. This was the beginning of a financial crisis that would change the world. Lehman Brothers, founded in 1850, had grown into one of the largest investment banks in the world. Its collapse sent shockwaves through global markets, leading to a recession that affected millions. The roots of Lehman's downfall lay in risky investments and an overheated housing market. Banks like Lehman lent money to borrowers who couldn't pay it back. As early as 2007, signs of trouble were evident. Lehman's stock price plummeted, and its credit rating dropped, signaling growing financial instability. In the summer of 2008, Lehman tried to sell itself, but failed. By September, it was too late. On Sunday, September 14th, the company filed for bankruptcy protection. Lehman's failure triggered a panic. Banks stopped lending to each other. Credit froze, and stock markets around the world crashed, marking the start of the Great Recession. The impact was felt worldwide. From Europe to Asia, economies slowed, jobs were lost, and governments struggled to stabilize their financial systems. Governments intervened with bailout packages and stimulus plans. The U.S. government injected billions into banks, aiming to restore confidence and prevent further collapse. The Lehman collapse reshaped banking regulations globally. It led to stricter oversight and reforms designed to prevent another financial crisis from happening again. In the wake of Lehman's collapse, banks hesitated to lend to each other, freezing credit markets worldwide. This liquidity crisis paralyzed economies, making it hard for businesses and consumers to access funds. Stock markets plummeted globally as panic spread. Investors sold off assets, causing unprecedented drops in stock prices and eroding wealth overnight. Markets lost trillions, and confidence in financial institutions waned. Unemployment surged as companies cut costs. Millions lost jobs, leading to widespread hardship. The global economy entered a deep recession, affecting every sector and region differently. The automotive industry suffered heavily. Companies like General Motors and Chrysler faced bankruptcy. Their struggles highlighted the interconnectedness of industries and the cascading effects of economic downturns. Housing prices dropped sharply, exacerbating the crisis. Homeowners found themselves underwater, owing more on their mortgages than their homes were worth. Foreclosures soared, leaving neighborhoods blighted. Governments worldwide implemented fiscal stimulus packages to revive economies. These included infrastructure projects, tax cuts, and direct cash payments to citizens aimed at boosting consumer spending. Central banks lowered interest rates and initiated quantitative easing programs. These measures aimed to inject liquidity into the financial system and encourage lending and investment. The Dodd-Frank Act was passed in the U.S., creating new regulatory bodies and rules to prevent future financial crises. It mandated higher capital requirements for banks and created the Consumer Financial Protection Bureau. Protection Bureau. Global regulators agreed on Basel III standards, requiring banks to hold more capital and improve risk management practices. These reforms aim to make the financial system safer and less prone to shocks. Lehman's failure exposed vulnerabilities in the shadow banking system, including complex derivatives and off-balance sheet entities. Regulators sought to increase transparency and oversight in these areas. The crisis highlighted the importance of international cooperation in managing financial risks. Countries worked together to coordinate policies and share best practices in regulation and recovery efforts. In the aftermath, there was a renewed focus on social safety nets and support systems for those affected by job losses and economic hardship. Programs like unemployment insurance and food assistance expanded. The crisis also spurred innovation in alternative finance models such as peer-to-peer lending and crowdfunding. These platforms offered new ways for businesses and individuals to access capital outside traditional banking channels. Financial education gained prominence as a tool to empower consumers and investors. Initiatives aim to increase awareness about personal finance, investments, and the risks associated with different financial products. The collapse of Lehman Brothers had long-lasting impacts on global financial markets. Trust in financial institutions was shaken, and many investors shifted towards more conservative investment strategies. The crisis underscored the need for robust stress testing and scenario planning within financial institutions. Regular assessments became crucial to identifying and mitigating potential risks before they could escalate. The concept of too big to fail came under scrutiny post-Lehman. Policymakers debated whether large financial institutions should be broken up or subjected to stricter regulations to avoid similar crises. The crisis revealed the interconnected nature of the global economy. Events in one country could have far-reaching consequences elsewhere, emphasizing the need for coordinated international responses. The role of credit rating agencies faced increased scrutiny after the crisis. Critics argued that flawed ratings contributed to the housing bubble and subsequent collapse, prompting calls for reform. The crisis led to a re-evaluation of executive compensation practices in financial firms. There was growing concern that excessive incentives for risky behavior had contributed to the crisis, prompting regulatory changes. The collapse of Lehman Brothers marked a turning point in the financial industry's relationship with government. The era of minimal regulation gave way to a more interventionist approach to ensure stability and protect public interests. In the years following Lehman's failure, there was increased emphasis on transparency and disclosure in financial reporting. Companies were required to provide clearer and more detailed information about their financial health. The crisis sparked debates about the role of government in the economy. Some called for stronger regulation and oversight, while others advocated for a return to free market principles and reduced government intervention. The legacy of Lehman's collapse is felt to this day. The financial landscape has changed significantly, with new regulations, a more cautious approach to risk, and ongoing efforts to prevent another global economic meltdown. Lehman's failure exposed weaknesses in the global financial system, leading to stricter regulations and oversight. Banks were forced to hold more capital and improve risk management practices. The aftermath saw a global recession, with unemployment rates soaring and economic recovery taking years. Governments worldwide implemented stimulus packages to mitigate the impact. The crisis highlighted the interconnectedness of economies. Countries had to work together to stabilize markets and restore confidence in the financial sector. In response to the crisis, the Dodd-Frank Act was enacted in the U.S., aiming to prevent future financial crises by reforming regulatory structures and enhancing consumer protection. The collapse of Lehman Brothers triggered a global financial crisis affecting millions worldwide. It exposed systemic weaknesses and prompted regulatory reforms to prevent future disasters. Regulations like Dodd-Frank aim to strengthen oversight, but questions remain about their effectiveness. Financial systems remain complex, requiring constant vigilance and adaptation. The lessons from Lehman's failure are clear. Transparency, regulation, and international cooperation are vital to safeguarding the global economy from catastrophic collapse. As we reflect on this pivotal moment in history, it's crucial to remember that financial stability relies on collective efforts to learn from past mistakes and innovate for the future. Every individual has a role to play in shaping a resilient financial system. Awareness and education can empower us all to make informed decisions that contribute to economic stability. To ensure our financial systems remain robust, we must stay vigilant, promote ethical practices, and support policies that prioritize long-term sustainability over short-term gains. The story of Lehman Brothers is a cautionary tale of hubris and oversight. By understanding its causes and consequences, we can work towards a safer, more equitable global economy. Remember, the health of our financial systems affects everyone. Let us commit to learning from history and advocating for reforms that protect the economy for generations to come. In conclusion, while the collapse of Lehman Brothers was devastating, it also provided a critical opportunity to reassess and improve the global financial system for the betterment of all. By fostering transparency, accountability, and international collaboration, we can build a financial world less prone to crises, ensuring prosperity and security for everyone involved. Let us take responsibility for our financial futures, advocate for change, and strive for a global economy that thrives sustainably and inclusively, free from the shadows of past failures.